Money at Work continuing series. Today's episode centers around warning signs that the stock market may be potentially setting itself up for a crash. To determine whether you're headed into a downturn, it's important to pay attention to the warning signs that the market practically yells to euphoric investors who often fail to listen. In fact, it's the euphoria of dramatic gains over time that often leads investors down the wrong path, resulting in market crashes that follow. But what exactly are those warning signs? And are they reliable in terms of predicting market crashes? Let's look at the 7 signs. Number 1, prolonged easy monetary policy. The United States Federal Reserve Bank, also called the Fed, is the central bank of the US, meaning that the bank is in charge with determining the monetary policy for the US. Considering the stock market, at its core, is nothing but a system that allows for the movement and balance of cash as well as value, Fed's going to play a big part in the market activity. One of those ways that the Fed interjects itself is with the Fed funds rate. The Fed's fund rate is an interest rate charged between banks to lend excess funds overnight. When this rate is lower, interest rate on loans like mortgages, auto loans, credit cards, and others become much lower. And what that does is it spurs a wave of lending and borrowing. Of course, when consumers are able to borrow more money relatively cheaply, they tend to do so. And that creates tons of liquidity in the US economy. As a result, spending ensues. That leads to higher revenues as well as profitability for corporations, and ultimately a bull market ensues. However, prolonged low rates can be a very bad sign because they cannot last forever. At some point, debt will have to slow, rates will have to rise and increase, and that's going to result in a tightening of consumer spending. And if the contraction is significant enough, stock market crash may happen. Number 2, bubble and market valuations. Bubbles appear in the stock market all the time. Some of the most memorable in recent history include the dot-com bubble of the late 1990s, as well as the recent real estate bubble of the 2000s. During the late 90s, excitement around the widespread adoption of the internet ran really high. Stocks that represented virtually any online company rocketed, and that led to outlandishly high valuations in the sector. Following the dot-com bubble burst, excessive monetary stimulus mixed with poor lending practices led to the flood of the demand for real estate, sending property prices skyrocketing. When the real estate bubble popped in 2007, massive sell-off began and the Great Recession set in. After the Great Recession, the stock market enjoyed the longest bull run in history, climbing for more than 10 years before the COVID-19 took its toll in early 2020. By mid-2021, however, the market had largely made a full recovery and many stocks were trading at record highs, hundreds or even thousands of basis points above the pre-pandemic highs, suggesting to some that the bubbles are starting to take place once again. Number 3, extended bull market. The market is thought to be a balanced system, but the reality is that it's anything from balanced. From day to day, month to month, or even year to year, the stock market struggles to keep valuations in check as the bears and the bulls argue over their points in a tug of war. Anytime the bulls take control for too long, the prices that investors pay to own stock go through the roof, and that generally creates what we call excessive overvaluations. On the other side of the chain, though, too much control by the bears sends stocks prices tumbling, and that results in extreme undervaluations. In fact, active traders can make it their life's work to take advantage of that arbitrage or that inconsistent balance in the market. Look at the amount of time that the trend in the market has been upward recently. It's uninterrupted run of the bulls that will considerably probably go longer, and that's going to be a sign that we're due for a reversal. Next up, corporate profits turn flat. One of the key drivers of the stock market is profit, and for good reason. Nobody wants to invest in a company that's losing money with no sign of profitability ahead. When profits are growing, investors are happy and they're willing to pile more money into that stock. However, value investors use the price to earnings, or what's called the PE ratio, which could also is a key metric to determine whether a stock is under or overvalued. In other words, a company's profits help determine the fair price of its stock. A clear sign that the market crash is coming is when profits begin to go flat. Investors are only happy when the companies they invest in are seeing, profitability and growth in that profitability. If profits stop growing, it raises questions about the company's ability to continue to grow ahead, and that leads many investors to abandon ship, driving stock market prices down. Rising inflation. Some inflation is natural. As the economy progresses, a slow and steady increase in prices for consumer goods, services, and other market categories are normal. It's why your great-grandparents could buy an entire lunch for a dime, and it's today why it's hard to find a stick of bubble gum for that same price. Inflation becomes a real problem when it happens too fast. The U.S. Federal Reserve has a target of stabilized inflation at about 2%. Which it feels like a healthy rate at which prices should increase over time. Leading up to market crashes, however, sometimes we see rapid inflation tend to take place, root, and gain traction. This creates a major problem. As prices rise, consumers become more physically conscious, often leading to an increase in savings activity and then a decrease in overall spending. From there, reduced corporate profitability is going to be on the horizon, which has the potential to lead to corrections or even stock market crashes. Next up, excessively high market sentiment. Emotion is a key driver of the movement of the stock market at any given time. When fear hits hard, market prices decline as investors sell their holdings, and market prices rise as investors buy shares when euphoria and greed sets in. In some cases, emotions can run extremely high, and that leads investors to throw all fundamental analysis out the window and make emotionally driven decisions that either drive prices to extreme undervaluations or overvaluations. When the market gets too euphoric and evaluations are too rampant, it's a sign that a crash is probably imminent. One of the best ways to gauge this is by using the Fear and Greed Index, which tells whether investors are too bullish or too bearish based on the two primary emotions that drive the market, fear and greed. And then last up, black swan event. In a black swan event, none of the above that we just talked about really matters. These rare, unforeseen events can happen completely out of the blue, and that leads to dramatic market declines. Some of the examples of recent swan events in history include, COVID-19, as well as the terrorist attacks of 2001. By their nature, black swan events are rare and unpredictable. There's no way to tell if a black swan event will happen tomorrow or 10 years from now, but when they do, they tend to lead to major market crashes. Remember, in closing, both bull markets as well as bear markets can go on much longer than anticipated or expected. While not all signs point to a crash, much of the positive economic data has been spurred by monetary stimulus that's led by low rates in the Federal Reserve bond buying, which simply just can't last forever. The good news is that declines don't last forever either. And even in the face of a market crash, wise investment decisions can lead to profits, which is important because if you're willing to do your research and wait for the right time, market declines and market crashes can be looked at as an opportunity. You want more information on personal finance, money management, investments, money matters. MillionaireMindset.life.